Ready to pass the CPA exam faster? Visit cpapass.ai. Today, net book value calculation. Master these fair transactions and questions. Imagine facing a FAR simulation where a company purchases machinery for $80,000, incurs shipping and installation, and you must calculate its net book value after 3 years of straight line depreciation. Many candidates freeze because they miscalculate the initial carrying amount or forget how salvage value alters the depreciable base. If you get this initial step wrong, every subsequent calculation for depreciation expense, accumulated depreciation, and gain or loss on disposal will cascade into a series of errors. Today, we will master the exact cost model formula so you can secure these highly tested points on exam day. Under US GAAP, the standard approach for reporting property, plant, and equipment is the cost model. The fundamental formula to memorize is net book value equals historical cost minus accumulated depreciation minus any impairment losses. Historical cost represents the total amount paid to acquire the item and prepare it for its intended operational use. This includes the purchase price, shipping, and installation. Remember, net book value is not market value. It is a systematic allocation of the historical cost over time. Mastering this formula is your first line of defense against tricky balance sheet questions on the FAR exam. To find the accumulated depreciation component of our net book value formula, we must first calculate the depreciable base. The depreciable base is equal to the historical cost minus the estimated salvage value. Under the straight line method, you divide this depreciable base evenly by the useful life to find the annual depreciation expense. For example, if a machine has an $85,000 historical cost and a $5,000 salvage value, the depreciable base is $80,000. If the useful life is 10 years, your annual depreciation is $8,000. Never depreciate the asset below its salvage value. Beware of two major examiner traps designed to derail your calculations. First, the examiners may try to trick you by presenting a revaluation scenario. Remember, applying the revaluation model is strictly prohibited under US GAAP. We must always stick to the cost model. Second, watch out for omitting salvage value in your depreciable cost calculation. For straight line depreciation, you must subtract salvage value up front. However, if you are using the double declining balance method, do not subtract salvage value when calculating the annual rate. Only use it as a floor to stop depreciating. Keep these rules straight to avoid easy traps. Let us solve our opening walkthrough. The company purchased equipment for $80,000 plus $3,000 for shipping and $2,000 for installation, giving us a historical cost of $85,000. With a $5,000 salvage value, the depreciable base is $80,000. Over a 10-year useful life, straight line depreciation is $8,000 per year. After 3 years, accumulated depreciation totals $24,000. Applying our cost model formula, the net book value is $85,000 minus $24,000, which equals $61,000. This is the exact value reported on the balance sheet. To wrap up, mastering net book value calculations requires a disciplined step-by-step approach. Always start by establishing the correct historical cost, ensuring you capitalize only necessary preparation expenditures. Next, calculate your depreciable base by subtracting salvage value, unless you are applying the double declining balance method. Remember that land is never depreciated, and the revaluation model is a major US GAAP distractor. To solidify these concepts and practice realistic simulations, head over to cpapass.ai to work through their comprehensive bank of practice questions. Keep these formulas handy, avoid the common examiner traps, and you will master this section on exam day.